Hi there, hope you're doing great today. I very often talk to new or aspiring real estate investors who are very often surprised on how one can get started in real estate and that there are many ways one can approach real estate investing. And so in today's quick video, I thought it would be helpful to share a few misconceptions about investing in real estate. As usual, our videos are for educational and entertainment purposes only and do not constitute tax, investment, or legal advice. So let's begin. The number one misconception is that real estate requires a ton of capital and a lot of money to invest in. And while it is true that real estate investments typically have a higher dollar ring associated with them, there's more than one way one can approach real estate investing. First of all, in many cases, the properties that you buy would be financed, with the lender bringing in 50 to 75% of the capital needed, the rest coming from you or partners. Namely, you can partner up with other investors to buy real estate. There are also a ton of creative finance strategy and working with the seller that one can deploy to minimize the amount of initial liquidity required. And as I mentioned in prior videos and articles, you can also choose to invest passively, where the minimum investments in many cases starts at $50,000. So you don't necessarily have to have a large down payment or the time or desire to deal with daily operations. So that's another way to creatively participate in real estate. Number two, that real estate is risky. Well, it is true that just like with any investments, there are risks in real estate as well. However, at the end of the day, as long as you do your proper diligence on the market, the sponsor, and the asset, at the end of the day, you're getting a real asset, a tangible asset, a property with real value. And historically, when comparing the performance of real estate investments, specifically commercial real estate and multifamily, relative to other alternative investments like the stock market, for example, real estate has outperformed those. It also serves as a great hedge against inflation, and we can talk a lot about inflation and how it's measured and what it really is. However, over time, those hard assets retain their intrinsic value. So I personally view them as less risky than other types of investments like stocks and bonds. Number three, that real estate is a get-rich-quick option. That's not necessarily true for the accountants out there who know that real estate is a fixed asset, a long-term asset. You can probably appreciate the long-term approach. Real estate goes through cycles like many other investments, and so those values can fluctuate, but in the long run, thanks to the power of inflation and other strategies such as value add, it has the potential to appreciate in value, but that takes time. 5, 7, 10 years. It's not something that happens overnight. Yes, you can deploy quick strategies like flipping. However, those strategies that usually come with higher returns also carry higher risk as well as higher tax liability. So at the end of the day, there is no free lunch. So approach it with a long-term view and not a get-rich-quick mindset. Number four, you don't have to do it all. You can partner up with people, either other active partners when you form joint ventures or as a passive investor. You can hire a team like a property manager, contractor to do some of the day-to-day heavy lifting or rehab operations. So you don't have to do this alone. Number 5 is investing in your backyard, and that is the only option. That is not necessarily true. All of the investments that I've taken on have been out of state for a variety of reasons, mostly pertaining to my own investment objectives and criteria. But you don't have to invest in your backyard. You can invest in other states, again, by leveraging your network and partnership. Number 6, that it is too complicated and impossible to do. Yes, there are a lot of different factors to consider, such as the market, sub-market, impact of economic and macroeconomic events on the performance of your investment. But you can get started small. Start with one passive investment or one single family home. You don't need to go from zero to hero. Start small, gain that experience, get comfortable, develop those reps, and the second, third, fourth investment will be easier for you. And number 7 is that there is only one way to do it. Not necessarily true. There are a variety of asset classes within real estate, variety of strategies within each asset class or subclass that one can deploy to invest in real estate. And as we've mentioned before, you can either be engaged in a more active capacity or in a more passive capacity. So there are a number of ways to get started, so don't let that misconception deter you. So we hope you found today's video helpful, and if you did, please like, share, and subscribe, and we'll see you at the next one.